Good evening, ladies and gentlemen. My name is William Meadon, and I'm the manager of JPMorgan Claverhouse Investment Trust. I've been manager since March 2012, and my co-manager is Callum Abbott, who joined me a couple of years ago on the trust. Claverhouse is a £450 million investment trust investing just in UK equities. Aside from its performance against the all-share, which we'll come on to in a second, its key distinguishing feature is that it has put up its dividend every single year for each of the last 46 years. And that is the longest record of any investment trust just invested in UK equities on the UK London Stock Exchange. Now, I know what you're thinking. Why on earth should I invest in a UK fund? What about Brexit? Well, I've got bad news and good news for you on Brexit. The bad news is I don't know how it's going to play out. The good news is I know that I don't know. Now, that may sound trite, but it's really, really important in decision-making to know what you don't know. It's particularly important in fund management. It never ceases to amaze me how many people in our industry, with such little track record to support it, have really, really strong views of how Brexit's going to play out, on how the trade talks are going to play out with Trump. I don't know. I just don't know. But I know I don't know. I mean, there probably isn't a piece of paper long enough in the world to write down the things I don't know. But the good thing is, I know I don't know. Confucius described true wisdom as knowing what you don't know. But there are some things I do know, and I just want to share 3 of those with you this evening. The first thing is, I think I know that the UK stock market is pretty good value. Here's a chart which is called the yield gap, just to explain what that is. This is a line of the difference between the yield on the all-share, which is roughly 4.5% at the moment, and the yield on 10-year gilts, which is effectively the risk-free alternative. The UK government has never defaulted on its debt. So if you want risk-free money, you get roughly 1.2% lending it to the UK government, knowing you'll get your money back, but you just get 1.2%, and that's 1.2% flat. You don't get any growth in that. So the difference between the 4.5, roughly, and the 1.2 is shown on the far right-hand side there, and you can see where that's come from. So the higher this line is, ostensibly, the cheaper equities are compared to gilts, because you're getting a much higher yield, so you think that's really good value. What you can see when you take this chart back to the start of the 20th century, there have only been 2 occasions when that gap has been bigger, i.e. where equities have been cheaper compared to bonds. And that was the start of the First World War and the start of the Second World War. So this is really trying to attempt to contextualize the problems we know we all have in the world at the moment and the uncertainty there is, but ask yourself, are things really as bad as they were at the start of the First World War and the Second World War? So I think I know that the UK equity market is cheap. That's not going to say it's going to fly away in the future, but there's value there, certainly compared to the risk-free alternative. And companies are saying that. They're putting down hard cash. Here's a chart of the takeovers in the UK market since the Brexit vote of June 2016. And you can see just how many takeovers and the quantity of them, almost 1,000 billion, so almost £1 trillion of takeovers in the UK market compared to, I think it's 15 other European countries. So that's Shire being taken over, it's Sky being taken over, it's Fenner being taken over. These are really big, successful companies which are being bought out at a big premium, generally by overseas buyers because you've had the fall in sterling. But companies clearly think that other companies' shares are cheap, and they're putting their money down in a really big way in the UK stock market. I think that confirms that the UK equity market is cheap. The second thing I know is that the UK stock market is not the UK economy. Here's a pie chart of where the revenues of UK companies come from. And you can see that less than 30% of revenues of UK companies, if you buy the UK stock market, come from the UK. It's an accident of history that Glaxo, that BAT, that AstraZeneca are called UK companies. These are big international global companies where they have much more revenue coming from overseas than they have coming from the UK. So bear that in mind. When you buy the UK market, you are buying the global market, And if you buy into this, you're buying the global market on the cheap. The third thing I know about the UK market is it pays some really good dividends. Here's a map of the world which shows the dividends from the major developed economies, and in fact some of the emerging markets as well. If you look bottom left-hand side, the green circle, if you bought an index fund on the world index, you would have a yield of 2.6%. World companies, on average, pay out, that's the payout ratio, so what proportion of profits do they pay out in dividends? You really, for a shareholder-friendly country, want that to be quite a high number. But the world, on average, pays out about 40% of its profits in dividends to you as shareholders. If you look at the UK generally has really shareholder-friendly management. It pays out over 60% of profits earned to you as shareholders. So if income's important to you, really important to be invested and have some money in the UK stock market. And it yields, this is MSCI, it's slightly different than the 4.5 I quoted, but it's 4.8% at the end of April. Now, the eagle-eyed amongst you will have noticed there are a couple of markets that yield more. Russia yields 6.9%. Not a stock market without its risks. Bottom right-hand corner, Australia is the other one, yields 5%. But the Australian stock market is made up predominantly of commodity companies. So you're buying, ostensibly, you're effectively mining companies, if you just, so you're not getting that diversification that you're getting if you invest in the UK. So dividends are plentiful in the UK. And we'll come on to see in a second just how important it is to have dividends paying regularly to you. We've heard from previous speakers that the markets at the moment, and you know, are really becoming more volatile. We're getting towards the end of the bull run. 2018, the market went down. The UK market went down about 10%. Most equity markets, most asset classes went down last year. But it's the first time the market has been down in the UK for 10 years, since 2008. But it's going to become more volatile, and you need to get used to that. Now, the temptation for you may be to think, well, that's great, the stock market's going to go up and down, so what I'll do is buy low and I'll sell high and I'll spend my days trading the stock market. Sounds fun, and if you're good at it, you can probably make some money. But I can tell you, as a professional investor, it's really, really difficult. And if you get it wrong, it's really expensive. Here's a chart of the returns you've got, the far left-hand side, if you've been invested in the UK stock market since the start of the century, since 2000, and you'd done nothing, you'd left it in there and not traded it, you'd have had a return, total return of 5.1% per annum. If, because you were trading it and you weren't in that day, you got it wrong, you missed the best 10 days in those 18 years, not the best 10 days per annum, the best 10 days in that 18-year period. Really quite easy to do. If you weren't invested fully for those 10 days, not knowing obviously when they were going to come, your return, and you've been invested for all the other days, your return would have been 1.7% per annum. Less than half of just leaving the money in there. If you miss the best 30 days, your return goes negative, -2. If you're not there for the best 50 days, by some quirk of fate, is that exact symmetry to the plus 5.1, your return goes -5.1 per annum. So if you want to trade the stock market, you think you're really good at it, make sure you really are good at it, because if you get it slightly wrong, it's really, really expensive. The good news is there is an alternative. The alternative is to do nothing. Do nothing. If you can afford to, if you don't need the income, reinvest the income and sit back and let compounding do the rest. Albert Einstein, one of the cleverest men who ever lived, said compounding was the most powerful force in the universe. Warren Buffett was once asked how he became so wealthy, and he said there were 3 reasons. He said, I was born American. He said, I had some lucky genes. And thirdly, he said, I understand compound interest. They say if you understand compound interest, you earn it. If you don't understand it, you pay it. So with that in mind, I thought I'd just do a bit of maths for you on Claverhouse Investment Trust, and I'll give you a bit more detail on that trust in a second. But I thought, what happened if we'd have left money in Claverhouse in a tax-free wrapper, so the ISA allowance of 20,000. I know you couldn't have invested 15 years ago 20,000, but if you put it in a tax-free wrapper, a pension fund, a SIP, say, if you'd needed the income, so you took the income out to spend, the capital-only return would have been enough to put one of your children through university and have £12,000 left over to do whatever, say for a deposit on a house. If you'd reinvest the dividends, if you didn't need that income, the compounding really kicks in. You'd have had enough to put two of your children through university and have 15,000 deposit left over for a flat. I mean, this really is life-changing stuff. So, Claverhouse, let me tell you a bit about this investment trust, which I've been managing for 7 years. You may wonder who this gentleman is here. He's not our CIO. He is Viscount Claverhouse. Well, you think, well, who is he? He was a Scottish nobleman from the 18th century, and he was known as Bonnie Dundee. And this trust, I joined Fleming's in 1996, and this was originally a Fleming's investment trust. JPMorgan took over Fleming's in 2000. But Fleming's founded their business, as some of you may know, in Dundee. And for purely sentimental reasons, they wanted this trust to be named after somebody connected with Dundee. So Bonnie Dundee, Viscount Claverhouse. Founded in 1963, it's about 450 million market cap. It's UK only. It's a very focused fund, well, quite focused fund. It's 60 to 80 stocks. We tend to run it at the lower end of that 60 to 80, currently 62 stocks in the portfolio. But it is risk controlled. What does that mean? It means we never have stocks in the portfolio, no matter how much we like them, that are too big a part of the portfolio. And if I can, over questions later, if he wants to go into risk controls, or over drinks later, I can talk you through. But we're always aware that we could be wrong on something. So if we really like a stock, like Fevertree's in the portfolio, we won't put 5–6% in the portfolio. We'll have a control position in Fevertree and take profits along the way as it goes up. Similarly, so there are some really, really big stocks in the UK market, the HSBCs, the Glaxos. And even if we don't like them, we'll have some in there, just in case they run away and do well. So we're trying to, this is what I call a get-rich-slow fund. We're not trying to, in the world of hare and tortoise, this is more tortoise than hare. But in that fable, it is worth remembering which one of those two won the race, and it wasn't the hare. So, if we can get you in a risk-control way, slowly, gradually, consistently, to where you want to get to, I think that's better than volatile performance along the way, and possibly, not doing very well in the race at all. What else can I tell you? It's a geared portfolio. Like most investment trusts, we employ gearing. We have some debt to do that. We can go 5% cash when we're very bearish, but we've never employed that. We have a 2020 debenture of 7%. That's pretty expensive debt. The good news is, you can see from the date, 2020, that rolls off next year, and we've refinanced already at less than half that rate. But the key point to take away is, it's like most investment trusts, we employ gearing. So, it's currently 7% geared. So for every £100 you give us, you're effectively putting 107 in the market. Since we changed to this approach, the more focused approach, and I came on board as manager, there's the performance record. The NAV has outperformed the benchmark, the all-share index, by approximately 2% per annum. And the share price, because the discount has closed from some 14% to currently about 2%, the shares have outperformed by 3.5% per annum. As importantly, that dividend. We've seen how important it is to have dividends rolling in and consistently rolling in, has put up its dividend at Claverhouse every year for each of the last 4 to 6 years. And that dividend is still covered by profits, and we have the best reserves in the income sector, because we've had prudent boards over the years who, in investment trusts, you can tuck away in the good times 15% of your income for when times inevitably get a bit tougher later on. So we've got those really great reserves, so that if things get difficult in the UK stock market in income terms, we can draw upon those. And that gives us comfort that we can keep that track record going. There is the record of the last 10 years. You can see the income's gone up at just over 5% per annum. And you can see that the board has recognized that we've got those really great reserves. They don't want to get too big, and you can see the dividends accelerating away in more recent years. Investment trusts, as probably all of you know, are a really great vehicle for income because you can tuck this money away. You can smooth those income payments. The left-hand side here shows the income you would have had from an open-ended fund. If you'd have bought an open-ended fund, say you bought an index fund, that is the annual income you would have had. The good news is a lot more bars above than below. So you'd have done okay. But look how volatile it is. Look what happened if you were dependent on income in 2008, 2009, 2010. I think you had less income in 2010 than you had in end of 2007. In an investment trust, the blue chart here is Claverhouse, is smooth. The market is lumpy, so it's a smoother income flow. And the good news is you can just see the blue chart is slightly above the green chart, so it's smoother, and you get more income because of that compounding effect. That's got to be good news. There's the track record. In the 7 years, just over 7 years and 1 month since we changed the approach. The shares have compounded at 11.3% per annum, which is more than double the share price. And that's well ahead of the all-share index, which has done some 70%, which is 7.6% per annum. As importantly, we've done this in a consistent manner. There are quarterly returns. The green are where we've outperformed, the red are where we've underperformed. And we've outperformed, if you add those up, more than 70% of quarters. So outperforming the all-share index, consistency of dividends, and giving you outperformance in a controlled manner. So in conclusion, 4 minutes left, Claverhouse continuing to provide consistent performance and, as importantly, consistent of income, which I'm sure is really important to many of you, and we've seen the maths of how important that consistency of income is. After the poor year of last year, we know the UK stock market has rallied this year, but we still think it's pretty good value, but it's going to become more volatile. There are lots of uncertainties around. I'm not actually sure there are more uncertainties around now than there ever are. I think it's just the sort of news, 24/7 news world that we live in. But bear in mind, when you open the newspaper, when you read the news, and you think, oh, God, that's happened. I must sell all my shares. If it's in the newspaper, professional investors know about it, other people know about it, so it's probably almost certainly in share prices already. Volatility is increasing. If you try and trade the market and you get it slightly wrong, it's really difficult, it can be really painful, it can be really expensive. So don't time the market. Have the courage to do nothing. Just whip yourself up into a state of inertia. Just leave your money invested. I want to leave you with 2 quotes. One from when he died, he was the richest man in the world. And in fact, if you indexed his wealth when he died, I think it was 1930, just by the rate of inflation, he'd be the richest man alive today. He'd be richer than Bill Gates. He was called John D. Rockefeller, and this is what he said. He said, you know, the only thing that gives me pleasure is to watch my dividends coming in. There was another man who lived, he was born roughly within a few years of Rockefeller. He was arguably the brightest man of his generation, the wittiest man of his generation, the most erudite man of his generation. But in complete contrast to Rockefeller, he died an absolute pauper. And when he died on the 30th of November, 1900, this is what the conclusion he came to. Oscar Wilde said, it's best to have permanent income than to be fascinating. So with that in mind, who knows, if those two are alive today, maybe they'd find some space in their portfolio for Claverhouse. But with that, I've finished. Thank you very much for your time, and I'm very happy to take any questions later.